Good morning. We are waiting for a few more minutes to start the dialogue. Well, good morning, good afternoon, good evening, wherever you are in the world. I'm Leandro Passarella. I'm a tax lawyer and a professor of basic income taxation at UTDT Master of Tax Law program. Today is August 26, 2020. I'm with Professor Celina Valls. Hello, Celina.
Hello, Leandro. Hello, everyone. Welcome to the UTDT Global Tax Talks. Today, we start this project called UTDT Global Tax Talks. Leandro, could you please explain what this entails?
Yes. Well, UTDT Global Tax Talks is a platform fostering an interdisciplinary dialogue among scholars and faculty members from all continents on a single hard tax topic, following Universidad Torcuato Di Telas' motto of academic excellence, pluralism, and equal opportunity. Based on a common questionnaire, tax law professors, economists, and political scientists will share their views on the same issue, offering the audience a comprehensive analysis. In its first edition, UTDT Global Tax Talks will cover the impact of the COVID-19 pandemic on the international tax system. To begin our dialogues, we have a roster of 10 recognized scholars. Today, we have the honor of speaking with Professor Reuven Avi Yonah.
Thank you. Reuven Avi Yonah is the director of the International Tax Program at Michigan Law School. He specializes in corporate and international taxation. He has served as consultant to the US Department of Treasury as well as to the OECD on tax competition. He has published more than 250 books and articles, some of which are used as standard books in our tax courses. Professor Avi Yonah, welcome to the UTDT Global Tax Talks.
Thank you very much. It's a real pleasure and a great honor for you to have me, and great to see Leandro and some of my old students again from many years ago, and it's a great pleasure to be here.
Great. Well, okay, let's start with an introduction of the issue. In December 2019, a minuscule life form, a coronavirus, appeared on our human world. Since then, it has silently spread using human beings and their advances in technology as means of transportation. Nowadays, coronavirus is an uninvited guest in our lives and is everywhere, and human beings cannot see it or detect it before its unsettling presence becomes real, once it has already infected human beings, jeopardizing their lives. Governments initially reacted to the virus spread, requesting us or directly requiring us to retreat to our homes, disrupting our normal lives. Borders were closed, planes were grounded. We cannot move far from our places of residence, and if we do, in many cases, we are required to comply with a preventive quarantine. We live very much as if we were characters of a science fiction book. Until an effective vaccine is designed to allow us to get back to normal, or the pandemic fades away naturally, human beings will continue to be pushed to transform our lifestyles. This transformation includes the way in which we do business. Social distancing is now the rule, and electronic commerce is widespread. Everything is delivered to our doors or screens, and this behavior will likely remain once we learn to coexist with the pandemic. If we change the way we do business, this for sure has tax implications. So far, governments have used tactics and tools already known to them to deal with this pandemic's effects on their country's economies, and their long-term results are uncertain. In UTDT Global Tax Talks, we will discuss various tax issues derived from the challenges that COVID-19 poses to human beings, economic relations, and how states could deal with them effectively to continue generating revenues to provide the essential services that human beings expect to receive from them. For that purpose, Celina and I have prepared a set of questions that was sent to the speakers in anticipation to our dialogues. We don't know their answers yet, and we will listen to them attentively to provide our conclusions on November 11. Professor Avi Yonah has prepared a presentation that covers several of our questions, especially the last one, which refers to tax policy makers thinking out of the box. While Celina and I may still have some follow-up questions afterwards, we encourage the audience to send theirs to us through the chat window during the presentation. Reuven, the floor is yours.
Thank you very much. Thanks again for having me. So I think the idea of this presentation is basically to talk about how governments react to the pandemic and to the revenue needs that they have, which have been significantly increased. I mean, there's one that's relatively clear is that government will need new sources of revenue to offset the costs and build a better social safety net. And as you know, all over the world, governments are borrowing and spending at a pace not seen since World War II. And at the same time, the revenues from both the income and the consumption taxes are significantly down because of pandemic-related slowdowns in economic activity. So the result is, as you know, unprecedented levels of debt that even with low interest rates mean inevitable needs for more revenue down the road. So this is basically trying to think about how some of these revenue needs might be met. And we need to distinguish between short, medium, and long-term solutions. I think in the short term, like the next 5 years, some governments like the US might enact excess profit taxes on companies that benefit from the pandemic and digital services taxes to capture some of the increase in the use of some services that may escape regular income and consumption taxes. In the medium terms, I think we're looking at permanently higher taxes on rich and corporations to address inequality that is likely to be exacerbated by the pandemic, and adopt carbon taxes to mitigate climate change. And in the long term, there may be new and innovative sources of revenue that may emerge, like taxes on artificial intelligence, cryptocurrency taxes, financial transaction taxes, and others. So let's talk first about short-term revenue sources. I think in the short term, there are two types of taxes that are plausible. For countries that are primarily residence countries, like the US, there may be a move, and there is now a move in the US, to adopt a kind of tax that was first seen in World War I and then again in World War II, which are excess profit taxes. Source countries like Argentina may have a more difficult time doing that, but they may be able to capture some of the same profits by using taxes like digital services taxes. So given that most companies are losing money, but some are now earning excess profits due to the crisis, it may be time to revive the wartime excess profit taxes that the US and other countries deployed successfully in World War I and World War II to prevent the winners from achieving this form of opportunistic and just enrichment. So the way this works is basically a tax that's designed to tax the proportion of profits that derives from an external event not of the taxpayers making. So the last one was enacted in 1940. and the rate was very high, ultimately up as high as 95%. So it's really important to distinguish between normal profits and excess profits. And the idea basically is not to try to measure excess profits directly, but to try to see whether you can have a profit that exceeds the norm. And in order to do that, you basically use a method that involves average earnings from pre-crisis years. Given the diversity of corporations that are likely to offer the pandemic, I think that's the easiest way of doing it. And you take the average based on pre-pandemic years, so 2016 to 2019, for example. And then you take a credit for the average earnings, plus you give a credit for R&D, that's the way it was done, and then apply the high tax rate to the rest of it. And the resulting tax may be reduced by credits for wages of additional employees hired in 2020. So that's one way in which you can capture excess revenue during the pandemic. For countries that are source countries, that's more difficult because you don't have excess corporations with resident corporations with excess profits, but some of the same profits can be taxed using digital services tax because they capture one of the likely types of transactions that result in excess profits in this pandemic, namely digital services taxes provided by companies like Amazon, Facebook, Google, Netflix, and also Zoom, the platform that we're using now. There are about 26 trillion of such services globally, and the amount is likely higher during the pandemic. And I think for countries that are not a residence location of the tax target, that is basically every country other than the US, it makes sense to impose the digital services tax, even if, as is plausible, the cost may be shifted to local consumers, because digital services tax are relatively easy to administer, and they recapture some of the spending of entertainment, as well as some business spending that is hard to tax with a normal VAT. So they're supposed to disappear, as you may know, after the OECD completes its BEPS 2.0 project, but I'm really doubtful that there will be a consensus-based multilateral solution, certainly not this year and maybe not next year also. As you may know, the current proposals have two pillars. One of them is Pillar 1, which directly addresses the digital economy by dividing the income of multinationals into 3 tranches. And Tranche A is supposed to be taxed in the market jurisdiction, that is where the sales of goods, services, or advertising are targeted, regardless of the traditional PE and arm's length standard limits. And Tranche B is supposed to grant more revenue to source countries based on a fixed return on marketing intangibles, but subject to the PE and ALS limits. And Tranche C is supposed to grant them some more, but only subject to binding arbitration. Now, the problem is, fundamentally, that Tranche A is likely to be small or too small to satisfy the needs of the market economies, and the other two are subject to the odd limits, and so they're also likely to be less than satisfactory. We can discuss more of that about the Q&A. Pillar 2, it's based on the American tax reform, the TCJA, and it implements a modified version of the current US GILTI and BEAT. That is a minimum tax on both outbound investment and inbound investment. There should be a minimum residence tax if the source country does not tax, and a minimum source country if the residence country does not tax as well. Those are in principle the implementation of what I call the single tax principle, that is the idea that there shouldn't be any income that is not taxed, but they are also problematic. The consensus-based approach in Pillar 1 is likely to give the source jurisdiction too little because Tranche A will be too small, but Tranches B and C are unlikely to give them anything because they're subject to the old limits. And the problem with Pillar 2 is that the minimum tax rates that are proposed are too low and are subject to limits that mean that the actual revenue rates will be minimal. So I'm doubtful that this will really be the solution to the problem. And that's why I think digital services taxes are likely to be with us to stay. Now, in the medium term, I think we need more significant changes to tax policy. And at least in the US, I would say we need a corporate tax rate that is significantly strengthened and made more progressive, and an income tax on the rich needs to be strengthened. There's also a carbon tax needs to be implemented for countries that don't have it, like the US. As far as corporate taxes is concerned, I mean, I think that current corporate tax is inadequate to deal with the increasing monopolization of the economy that is led by big tech, for example. They've basically become, for the early 21st century, what the big companies were in the early 20th century. That is the embodiment of corporate power that enjoys a near monopoly on an important segment of economic activity. And indeed, incumbent platforms can potentially abuse the monopolistic power in such a manner that harms democracy and consumer privacy, as well as eliminating competition. There are three ways in which a corporate tax can limit corporate power. First, even a low corporate tax requires a corporation to provide detailed information about their activities, like country-by-country reporting. Secondly, potentially the corporate tax, like any tax, involves the power to destroy if the rate is high enough. And the knowledge that this could happen may limit the aggressiveness of corporate manager, that is the founders of the big tech, for example. And thirdly, most importantly, the corporate tax can be used as a regulatory device, with the effective rate being raised or lower either for specific desirable or undesirable activities or in response to an overall corporate social responsibility score. So currently, in the US, we just have a flat corporate tax and it's pretty low, 21% of taxable income. Before 2017, there was some progressivity, but it was really limited to small corporations. And the rationale was corporations do not bear the burden of the tax, people do, and therefore it was an inappropriate vehicle for redistribution because of the incidence of the tax was not clear. But I think if the corporate tax is conceived primarily as antitrust device, that is anti-monopoly, then a sharply progressive corporate tax makes sense. The purpose of monopolization, after all, is to increase corporate profits, and the more monopolistic a corporation is, the higher its profits are likely to be. And the purpose of anti-competitive mergers is to eliminate competitors that will decrease profits. Therefore, I would argue for a highly progressive corporate tax, even with high rates at 70 or 80% for a very high threshold, like $10 billion, like all the big tech in 2019 had such profits. The more competition there is in an industry, the lower the likelihood of very high profits like that. Now, we also need higher taxes on the rich. In the US, certainly the individual income tax is not progressive enough. The basic problem is that dividends and capital gains are really taxed at a low rate, 23.8%. And even normal wage income is only taxed at 37%. And heirs can sell appreciated assets with a step-up basis and therefore not pay capital gains tax at all. And I think one solution, which has been proposed by several, is essentially an accrual-based or mark-to-market regime for taxing capital assets. That's relatively easy to do for publicly traded assets like stocks and bonds, because you can solve both the valuation and liquidity issues. For privately held assets, you can defer it until they're sold, but then an interest charge can be added to the tax to eliminate the value of deferral. And step-up basis of that must be eliminated. If these steps are taken, the income tax rate on capital gains and dividends can be equated to the rate on wages and raised significantly, although I would say 50% is more or less the maximum that you can achieve, because historically, there's never been such a high effective tax rate in the top 1% in the US, except during World War II. And we might also, and this is, I know, a major issue in a place like Argentina, consider the idea of a wealth tax, although a wealth tax has significant issues that we may also discuss in the Q&A. One difference, of course, is that in the US, we have an effective exit charge on people expatriating, which is not true in the EU and in many other countries. So that's one reason that I think this is a very country-specific issue, and the devil, as they say, is in the details. We can discuss this more later. Then I think most people would now recognize that carbon taxes are needed to address climate change in a country like the US, which doesn't have them. And there's a broad bipartisan consensus that carbon taxes are more effective than simpler than cap and trade regimes. And politically, the increasing impact of climate change is likely to render such taxes feasible in the medium term. Then finally, in the long term, I would say it's likely the government will resort to new types of taxes on specific 21st century types of economic activity, such as, for example, taxes on artificial intelligence, such as robots, taxes on bits, which have been proposed, and maybe global financial transactions, such as cryptocurrencies. These all I think of as longer term, because most of them require a higher level of cooperation and is likely at present. So I don't think they can be implemented immediately. And in the US, I would say the one big gaping hole in our tax system is the lack of a value-added tax. We are almost the only country in the world that doesn't have one. And that seems to be an obvious reform that we should introduce. It's the only type of tax that can plausibly produce the level of revenue that the US needs in order to take care of its aging population, repair the broken health system and infrastructure, and invest the necessary resources to adequately educated citizens. And that is, I think, because every 1% of a broad-based VAT in the US can raise 100 billion each year. So even a relatively modest VAT of 15% would at 1.5 trillion be second only to the federal individual income tax revenues and exceed the payroll tax. And combining a VAT with a universal basic income subsidy can be quite progressive. So that's basically my presentation, and now I'm really looking forward to hearing your questions.
Thank you, Professor. Thank you very much for your interesting and I think provoking presentation. There are many questions that come to our minds. The first question that I would like to ask is, where does the international tax system stand if your proposals were to be implemented? Okay, because as far as I understand, there would be an excess profits tax in rich countries and digital services tax for developing countries or not so rich countries. Would there be a conflict between domestic tax law and tax treaties? Would the source and residence concepts still be relevant in the international tax system?
So I think that's really the key question. At the moment, I mean, the reason for the OECD movement towards BEPS 2.0 is to try to prevent unilateral action. But frankly, I don't think in today's world that's quite plausible because the likelihood that during a situation like the current pandemic, I mean, the general trend has been going away from globalization rather than towards it recently. And I think the idea that we will have a more coordinated system in the near future is low. So I think really the key is what kind of unilateral actions can countries take and what should be the response. So as I said, the proposals that I'm making do not involve coordination. But that doesn't mean that you need necessarily to live with double taxation. I mean, I think, for example, the key question with digital services tax is whether they would be creditable for income tax purposes. And I think there are, in fact, ways to design the DST so that it will be creditable. What you need to do is make it a substitute or tax in lieu of the income tax for the US, and that would mean that it might be creditable for income tax purposes, and you do not necessarily need to have double taxation. But it is certainly not impossible to imagine that if in a situation where countries were to impose these kind of taxes, they would essentially force a revision of the tax treaty network, because fundamentally the problem is, as you mentioned in your introduction, the current tax treaty network is really not fit for 21st century purposes. I mean, certainly the permanent establishment threshold needs to be revised. So does the arm's length standard. I mean, these are the things that the OECD has recognized. So I think from my perspective, the fact that countries will be taxing these kind of unilateral measures is an opportunity in order to rethink really the system in a way that is maybe more fundamental than what the OECD currently has in mind.
Okay, so talking about PE, the lockdown has not disrupted M&E's activities. Rather, they have adapted rapidly and have continued to operate remotely. During this period, their management may have been located in more than one country. At the same time, some of their activities in other countries may have been performed without the need of any local presence or any significant one therein. Home office has become the rule, and many employees and independent contractors have got used to it and may be reluctant to go back to their offices. It may no longer be necessary to travel so often again. Also, some M&Es may have decided to reduce their local presence in some jurisdictions. Assuming that the international tax system continues to be based on this distinction between source and residence, should the concept of PE be revisited and redefined, and how? Should these changes apply exceptionally to certain industries, or should they become the general rule? What do you think?
That's, of course, also a very important question. So there are two interesting and related issues here. The first one, which you kind of hinted at when you mentioned that companies may be run from many places, is a trend that people have been discussing for many years, but has been exacerbated by the pandemic. And I think basically the idea is, do companies have a meaningful residence anymore? Is it possible to define where a company is resident for tax purposes? Clearly, the American definition, which is thus based on place of incorporation, has never been an effective way. But now we're talking about whether you can actually still define corporate residence based on where a company is managed and controlled from. And what you're suggesting is maybe the answer going forward would be no, because you can manage it from many places at once. That remains to be seen. Now, as far as the PE is concerned, I think that suggestion that if companies don't have residence anymore, that means you need to go more in the direction of source taxation. And this is where I think there's a pretty broad consensus, including now within OECD, that the old definition of PE based on physical presence is obsolete. And I really think what you need to reimagine is a tax that is based on market presence, that is, and that includes users, even if they don't engage directly in market transaction, because their data is what is being sold. There's a very interesting recent IMF paper that suggested that big data in particular may be analogous to a natural resource that is owned by a country, and that access to such big data may justify digital services taxes based on that, or some kind of royalty based on that. So I think fundamentally you need to reimagine the concept as not something that is based on a physical presence or even on direct sales, but rather something that is based on utilizing a market. And then you need to put a threshold, and I think many people have developed suggestions for such threshold. I mean, I do think that you need a threshold in order to exclude de minimis transactions, but I think some kind of revenue threshold from a country may be appropriate, and I don't think that this should be limited just to the digital economy. I think this is something that should be applied to all companies.
Thank you. We have a question from the audience, Celina. You're muted, Celina.
Sorry. Yes, sorry. How can the global tax system be remade to serve the base of the global economic pyramid?
So that's a very good question too. I mean, what do you do about essentially global economic redistribution? That's what I understand the question to refer to. That is, what about, you know, the poor and you know, working class people everywhere, which is, as you mentioned, the base of the pyramid. And I think there are various ways to address it. I mean, one thing that's interesting about all of these proposals is that when people analyze proposals that are designed for market-based taxation, they conclude that it is in fact not contrary to the interests of developing countries. In general, certainly not the big ones, but even many of the small ones. Now, it is true that some countries will lose from such proposals, especially countries that now have a much higher profits booked in them than their entire economy, the tax havens in particular. But most, quote, real countries, countries that have significant real economic activities, would actually benefit from these kind of proposals. In addition, I think some of the more innovative sources of taxation that have been mentioned are the kinds of things that certainly can be implemented by a few countries and then potentially shared by the many. I'm thinking in particular about taxation on bits, which have been proposed by World Bank people to generate revenues that can be shared, and other taxation on cryptocurrencies, that's another one. But I think that, as I said, requires some level of cooperation that we don't have at present. But I don't think that the proposals that are currently now on the table to replace the old international tax regime are particularly regressive as far as developing countries are concerned. And I do think that the traditional form of tax competition that we've had before the pandemic was definitely not in their best interest.
Thank you, Professor. And thanks to Steve Dean, the NYU Graduate Tax Program Director, who is on the audience, for making this question. You stole one of our questions, Professor. Thank you. So it was great that we have the same views. So the question now, Celina, if you want to go to arm's length.
Okay, yes, thank you. Professor Avi Yonah, the pandemic affects the multinational intercompany transactions comparability. Which are the challenges and possible solutions to determine the arm's length range during this economic downturn?
Now that, of course, assumes that we are keeping the arm's length standard, but I think, you know, in the immediate future we do, and obviously people need to deal with the current transfer pricing system as it is, and has been true before the pandemic, that finding comparables for many transactions was really difficult, especially involving intangibles, and it's getting more difficult by the day. Personally, I think that the current system has some flexibility built in it that should enable us to deal with this. Especially, I'm thinking about the profit split method, which is one of the 5 approved OECD methods in order to adopt it, because the advantage of that method is that it involves a functional analysis of both sides of the transaction. And then you usually get a residual, and this is where I think the OECD is now opening up to allocating the residual, which is the extra profit that companies derive from their intangibles fundamentally, in ways that involve movements toward fixed formulas and the like. The current system does not allow for global formulary apportionment, but within the scope of the profit split, I think there is potential for saying, for example, that some of it should be derived from the research that developed the intangibles that are being utilized. Some of it should be derived from the market activities. And obviously, if we have an excess profit tax like I've proposed, it's not necessarily clear that all of that belongs to the residence jurisdiction, although those are the ones that are the most likely to implement them. I think they should be shared as well. So I think there is some flexibility even within the current norms to allow for forward thinking on these issues. And it's remarkable to me when the OECD started the first BEPS project in 2012, 2013, they wouldn't hear of any deviations at all from the arm's length standard or from permanent establishment. And now I think they're much more open to these kind of suggestions, and I think various countries are open to implementing that as well.
Okay, and do you think that it is time to move to a formulary apportionment?
Well, I've always been a fan of formulary apportionment. I think that in the longer term, that is a better solution. And I think that some of the current proposals on the table move us in that direction. But there are many technical challenges that need to be overcome before we get there. We may have more information as a result of country-by-country reporting that will be a good basis for this discussion, but I don't see us going all out to formulary apportionment in the near future. But I do think that incorporating formulary elements within an arm's length analysis, as I've indicated before, is a promising way to go forward.
Okay, thank you. And following up with our questionnaire, do you think that the current international tax system is designed to attribute tax jurisdiction among states fairly so that they can generate tax revenues to deal with situations like COVID-19 pandemic effectively? Or, and we complement this question with Eduardo Baistrochi, who is also at the audience, who says, are your proposals compatible with tax transfers from rich countries to poor countries?
So that's the basic problem. I think that what many countries now feel in the context of the pandemic because of their losses, but also before the pandemic, is that the current division of revenues among countries is not fair. And this is why you see an increased reliance on unilateral moves, primarily by developing countries and some developed countries as well, in order to enhance source jurisdiction and reduce residence jurisdiction. And I think that's going to go forward. And my proposals, I think, by and large, are consistent with that. That is, some of them are based on increased taxation by residence country, but not most of them. I think most of them do envisage significantly more taxation by source jurisdictions. And I think that the residence countries should grant more tax credits for these types of taxes in order to reduce double taxation as a result.
Okay, thank you. Celina?
Yes, yes, there is a question, yes, from the audience. What, Professor, what is your opinion about the proposal to include a new article in the United Nations Model Tax Convention for Digital Services?
So I think that's a very promising step forward. In general, as I've mentioned, I think that it is a good idea to try to impose some source-based taxation on the digital companies. And the UN should be at the forefront of that because the UN represents the interests of the source countries in particular. The question that I have, though, is how feasible it is to divide up the world between digital and the rest of it. Because nowadays, almost any company is a digital, and it seems to me that it might be difficult to draw a convincing line that segregates out only these type of services from other types of services. So I would encourage them to think more broadly about revising the PE threshold, for example, for any type of company, not just for so-called digital companies.
Okay. Let's go a little bit to the tax on individuals. Many countries are discussing the convenience of levying a wealth tax to collect revenues to afford the economic strains created by the pandemic. Would such a tax be a solution, or could it create more problems in the future? Would developing countries levying such a tax, considering that the resident net worth individuals may have moved their assets elsewhere, not only for tax reasons, but also because of political instability or absence of rule of law in their residence countries?
So I think that that's a very country-specific issue, as I mentioned. There are proposals to tax wealth directly in the US, and for us, it may be a feasible thing to do for several reasons. One is, I think that we do have the ability to impose effective exit taxes. We also have, more than most, developed a system to try to trace the offshore assets of our residents, although this is the FATCA system, which is imperfect, but it's certainly more developed than most countries. And I think that most individuals in the US that have significant wealth hold it in forms that are relatively easy to tax. I mean, if you think about, for example, the founders of the big tech companies, their wealth is mostly in the publicly traded shares of Amazon, Google, Facebook, and the like. And those obviously are relatively easy to reach and tax because they are visible, they are publicly traded, there's no valuation, there's no liquidity issues. And I think a significant portion of the wealth in the US is in that form. I think that really varies tremendously from country to country. I think countries that, even in the EU, they've had a hard time with wealth taxes because the European Court of Justice said that they can't really impose exit taxes for moves of people and unlike companies within the EU. I think most other countries have the same issue. And in addition, as you mentioned, many people in developing countries may have good, valid, non-tax reasons to put their wealth offshore because of political instability and the like. So I think that this really is something that varies from country to country. I think even in the US, it's more plausible, as I mentioned in the main presentation, that we will have some kind of mark-to-market tax on the assets of the rich, that is an income tax, not a wealth tax, in part because we may have constitutional issues with a wealth tax, although I think those can be resolved. But I think in other countries, the problems are significantly more acute, which is why this is not likely to be a worldwide solution to the revenue problem.
Thank you. Celina?
Okay, one question from the audience. Professor Avi Yonah, what could be the impact of the rise of China and India on the international tax regime?
That's a great question. And they are different from each other, which is also interesting. China and India are not exactly the same. And obviously, they are similar in the sense that they are very, very large economies that dominate some spheres of economic activity in the case of China, and are likely to become more and more important as goes by. What's interesting is that, at least in the past few years, India has been really an innovator as far as tax is concerned. They are essentially at the forefront of, for example, substituting for the permanent establishment threshold. They're at the forefront of developing digital services taxes. A lot of their tax system is very innovative. China, on the other hand, has been much more conservative, but in general has not been a big fan of the OECD efforts, especially BEPS Pillar 2, the minimum tax proposals, which really has received some pushback, and to some extent Pillar 1 as well, although because the Chinese also have their own digital giants. I think it is inevitable that those countries will play an increasing role. I think at the moment, for example, the Indians, somebody we discussed formula apportionment earlier, the Indians have a well-developed proposal for that they have been advancing. Then they put it on hold, but now they're pushing it again in the UN context. And I think that's likely to be emblematic of the role that these two countries will play in the future. That is the move in general from residence in the direction of source taxation and more market-based taxation is likely to be led by these two countries because they are the biggest markets in the world.
Thank you.
Perhaps this is going to be a hard question, but how do you think that taxpayers may react in general to any potential tax increases resulting from the pandemic? Okay, in your presentation, you spoke about an excess profit tax, digital services tax that would be mainly paid by consumers, an increase in individual income taxes, perhaps a wealth tax, a VAT, which is the income tax of the poor, if one may say. Could there be also a mix with a revision of government spending as well?
I think that's fair. I mean, again, that's depends very much on the country and the political context in which you are speaking. I mean, I'm of course coming from US perspective. We are a heavily under-taxed countries, I think, by any OECD standard. We don't have a VAT at all. We don't have high enough taxes on the rich or on large corporations. I think there's a pretty broad consensus that we should be increasing taxes at least once the pandemic recession is over, and on some companies, maybe even before that, as in the excess profit tax proposal. So I think these proposals were written primarily from an American perspective. I certainly would be willing to acknowledge, that in many other countries, the current tax level is much higher already, and there may not be a lot of scope to increase it. And B, that, I mean, I've always been in favor of also looking at the spending side of the equation. Again, from a US perspective, the problem is that we have, I think, widely acknowledged too little provision of government services, such as healthcare, such as infrastructure, such as education, that requires significantly more resources. This is why I think I'm in favor of the VAT, even though, as you say, it's regressive, because you can offset it by using the spending side of the budget in progressive ways. Even if we just have a VAT to shore up the so-called entitlement programs, Social Security, Medicare, Medicaid, those programs are so progressive in their essence that the overall impact of the proposal will be progressive rather than regressive. But it's also been proposed that we have a universal basic income allowance as part of the use of the revenues for the VAT and the like. So I think in the US, I think that we need more taxes, we need more revenues, and we need more spending as well. Other countries, that may not be the case. And in fact, part of the problem is that they don't really have the scope to increase their current taxes very much because they're already pretty high, including the VAT. This is why I do think that the digital services tax is a good proposal, despite the possibility that it may be shifted to consumers. I'm not sure that it always will be, by the way. That really, again, depends on market conditions in every country and in every economy. The fact that the big tech and the US government are so much against it suggests to me that it is likely not to be always shifted, because otherwise, why would they care so much? It's the kind of tax that is relatively easy to administer. So it's similar to the argument that is always said that countries should not be imposing corporate taxes if they're importing capital, because it's going to get shifted to local factors. But it is usually easier to administer such a tax than to try to collect it from the local factors. And so I think even if it's shifted, there is a justification for it, and it's the same for the digital services tax as well.
Thank you. Celina.
Yes, a question from the audience. Professor Avi Yonah, would it be possible to regulate tax competition among countries?
Great question. And that's something that people have been trying to work on for a very long time. The OECD, at least since the late 1990s, and its current effort can be seen as a continuation of that. I think fundamentally the answer depends on the number of countries involved. This is actually something that, on which I've somewhat switched my position relatively recently because of this issue. I mean, traditionally, most of the business income in the world is supposed to be taxed at source, and most of the individual income is supposed to be taxed at residence. That's the traditional compromise that dates back 100 years or so. The problem is that for business income, there are too many source countries, and for individual income, there are too many residence countries, and it's too easy to shift residence. I think that at least in the short term, the solution may be to curb tax competition by cooperation among the smaller number of countries. So if you look at the countries that are the residence countries of big multinationals, that's a very small number of countries, relatively speaking, especially if the EU can be expected to negotiate as a unit. And so it's basically the EU and the US and a few other countries. It is quite plausible to me that this smaller subset of countries can coordinate their activities on a global basis and tax their multinationals currently without deferral and without exemption on all of their income, especially since their corporate tax rates are now relatively low. All of them are in the low 20s. On the other hand, for individuals, I think there are, as I said, too many residence jurisdictions, but not too many source jurisdictions, because individuals generally funnel all of their investments into a relatively small number of stable countries. And so if just the EU and the US, for example, were to coordinate a withholding tax on all payments to individuals that are not going through a tax treaty jurisdiction, that would make a major step forward towards curbing capital flight and tax evasion all over the world, because most of the money doesn't stay in tax havens. Most of the money flows through tax havens to investment in these jurisdictions. So I think the answer to the tax competition problem is, yes, it can be curbed if the number of countries that are needed to cooperate is not too large. And the problem with the OECD effort has been that it has focused on the wrong side of the equation. That is, it has tried to coordinate more on the source side for business income and more on the residence side for individual income.
Thank you.
Another question from the audience. Do you think that the excess profits tax could discourage adaptation and innovation?
So that's, of course, a very good question. Since I don't have a lot of time, I skimmed over a lot of the details. You can find some of my papers on this online on SSRN, which gives some of the details. But for example, precisely for this reason, I've suggested that companies that are engaged in, for example, the search for a vaccine, be exempted from the excess profit tax on those profits. That is, in general, I would not apply to the pharmaceutical sector. And I've also suggested that companies that hire more people during a recession would get a credit for such hiring. So you can adapt an excess profit tax to current conditions, but the companies that I'm targeting more with these proposals are companies like, for example, Google or Amazon or Netflix, that really benefit from the fact that we're all sitting at home and watching screens or ordering online in a way that they had nothing to do with. And, I don't think, since they're quasi-monopolies, I don't think their activities will be limited by imposing an excess profit tax on them. In general, the economic theory about monopolistic rents is that they are likely to be earned whether or not you tax them, and that this type of tax does not really affect corporate behavior negatively. So I think from that perspective, this is a pretty good tax. And as I said, we've had it in the past, even though that was a long time ago, and it was generally considered a pretty successful and also politically popular tax when we had it.
Thank you. One person from the audience says the following. Thank you, Professor, for your presentation. I have been reading in the last day about the Laffer Curve, developed by supply-side economist Arthur Laffer. That is an economic illustrated theoretical relationship between rate of taxation and the resulting level of the government tax revenue. Do you think that is a model which can be possible to reduce tax rates in countries in general, VAT, sales tax, income tax, to influence in the increase in the tax collections?
So in principle, yes. I mean, I think that there certainly, it's possible to imagine a situation where tax rates are on the wrong side of the Laffer curve, that is, that actually reducing the rate will increase collection. That certainly was the impetus behind, for example, the great US tax reform of 1986, which generally decreased the rates but broadened the base in such a way as to collect more or less the same revenue as before. The problem is that I don't think most countries are there at the moment. Certainly not the US. As I said, our tax rates are quite low. And it's the same in most other countries. And you also need to distinguish. I mean, I think the Laffer curve really operates primarily for taxes where the tax has a behavioral impact on the behavior of the citizens, which is true for income taxes and VAT and many other taxes, but not, for example, for a tax on monopolistic grants like I've mentioned before. This is why in my presentation, I said that I would advocate a significantly higher corporate tax rate on a progressive basis than the top individual tax rate, because I think individuals are more reactive to this than corporations earning monopolistic rent. So I think that it really depends to a large extent on the context, although I wouldn't say that it is impossible to imagine a situation where the tax rates are so high and the base is narrow enough so that you can reduce the rates and broaden the base and get to a more positive revenue number as a result.
Okay.
Thank you.
And regarding your changes, do you think that the OECD could play a role and to implement them? I mean, if they were implemented, how should they be structured?
So I certainly would hope that the OECD could play a role. I mean, I think fundamentally my perception of the OECD process from 2013 on is that they have been behind the curve or behind the times. They've been very, very slow to adapt and have been primarily reactive to what countries have been doing. That is, the whole BEPS project really started in the context of the post-financial crisis era, where countries like the UK adopted diverted profit tax and the like. And so that essentially forced the OECD to start to try to do something. But what they did in BEPS 1 was, even though there was a lot of work involved, was really significantly inadequate. So then they needed to deal with these questions in BEPS 2. But even BEPS 2, I mean, fundamentally, they start, I think, in a pretty good direction, but then they gradually narrow it down under pressure. And the result is that the outcome that they come up with is not really adequate from the perspective of both rising revenues and also allocating revenues more justifiably between countries, which is why you see this proliferation of short-term measures. I would certainly think that once this crisis is over and countries have adapted maybe along the lines of what I've been proposing, then you can have the OECD step in again and try to act in its traditional coordinating fashion. But it also is possible that the times when a club of 30 rich countries can really dominate international tax is over, and that we really need to shift over, for example, to the UN as a more broader and more representative organization to do the work.
Okay, I think that the last question is the following one. Professor Avi Yonah, on the tax competition front, what about applying European Union state aid law on all countries in the world on a voluntary basis?
So that, I think, is a really interesting suggestion as well. In fact, we have some of that already in place, but it's limited because the WTO rules have put some limits on export subsidies for goods that are somewhat similar to the EU state aid rules. I think the fundamental problem with doing it that way, which even within the EU, as the recent Apple case illustrates, has been problematic, is that that means that you need to police every country in the world, which is why I said before, I think this may be an overreach, although I'm not saying that it is in principle not a good solution, but I think in practice nowadays, with all the problems that we're having in coordinating worldwide action through the WTO, for example, which has not been very effective recently, you get into significant more problems than if you try to coordinate the actions of a smaller number of countries, which is why my current proposals have tried to focus more on that and rather to try to develop a global standard that will be applied for every country with teeth. Voluntary basis is a different question. And in fact, it is interesting that a lot of the WTO success in this area has been by applying pressure on countries without enforcement action, without litigation. And that may be a promising way forward, as your question suggests.
Well, I think that this was our last question, right, Celina?
Yes.
Yes. So we are finalizing our first dialogue of UTDT Global Tax Talks within the time frame that we suggested of an hour. We thank you, Professor Avi Yonah, for being with us this time. Thank you for sharing your thoughts. And hopefully we'll see each other soon. And you can come to Buenos Aires to have a class full of people.
That would be wonderful, indeed. Thank you very much, and thanks for having me. I really appreciate it. Thank you. Take care.
Thank you, Professor. Thank you, everyone.
Thank you.
Thank you. See you next week. We will have next week our dialogue with Parto Shome and next Wednesday at the same time. See you then. Thank you. Bye-bye.
Sí.